We continue with our discussion on Unit 1 of the Wealth Management program, and we continue to talk about the introduction to the wealth management industry. In this particular section, we're going to talk about primarily what kind of regulation is guiding this industry and who are the major regulatory bodies that take care of the issues that arise in this particular industry. If you remember, in the previous section, we've already discussed that the ecosystem of this industry allows some sort of a conflict of an interest because of the loyalties of the advisor in this interest in this industry, the way the product gets sold, which is the client, the advisor, and the product manufacturer, and the equation between them as to how the product is being recommended or sold. Because the payment traditionally has happened from the product manufacturer to the advisor, anyone who does the transaction or just distributes products also starts calling himself or herself an advisor and starts advising the clients, because the end client is unaware or has lack of knowledge on the financial services space. The client invests in the product manufacturer's product based on this advisor's advice, and hence there is a conflict of interest because the payment is happening here. So if the product manufacturer pays more, there is a possibility that an incorrect product gets sold into the industry, right? Now, the regulatory bodies have basically understood this, and that's why a lot of regulation has started creeping into the entire spectrum of wealth management. We will talk about all the regulators that are there, and then we will try and incorporate over a period of this curriculum of this course as to how do they control this entire process in multiple ways, right? So we will look at the broad set of stakeholders who are essentially either a regulator or a player. So who all are regulators in this segment and who all are the product manufacturers, right? So you have something called as SEBI, which is Securities and Exchange Board of India. That's a regulator. You have IRDA, which is Insurance Regulatory and Development Authority. So this is a regulator. This is a regulator. You have stock exchanges, which are basically marketplaces where people will transact on variety of financial products or stocks. In a sense, they are also kind of regulators, right? Because they deal with some sort of they put in a mechanism around how stocks can trade or even funds can trade on a particular exchange, right? So they regulate the flow of that entire scenario. There are a couple of other set of people who are stakeholders. So you will have a stakeholder in the sense of a depository participant and a custodian. We will talk about these as we go along as to what their role is. Brokers, advisors are the guys who advise you on a certain transaction. So they are a stakeholder. They will be regulated by the regulatory agencies. AMC is an asset management company, which basically is another word for a mutual fund in India. Insurance companies, these are the product manufacturers. So they are the product manufacturers, once again stakeholders who will be kind of managed by the regulators. And NSE is a kind of stock exchange. They have something called as NISM, which is National Institute of Securities Market. They conduct a couple of exams. So these exams are necessary to be cleared before someone can become an advisor or call themselves an advisor, essentially, in the technical sense, and hence they are also a sort of a regulator. So that's the ecosystem in terms of who all are the major stakeholders. And of course, the final stakeholder is the client, who basically invests on the advice of the broker or advisor and invests in the product manufacturers, and everyone else basically kind of controls the ecosystem around that, right? Let's look at each one of them one by one and understand their roles as we kind of go along. So the first one is Securities and Exchange Board of India, known as SEBI. What is the role of SEBI? Now, SEBI is the approving or issuing authority for allowing a person or an entity to become an advisor. Earlier, anyone in India could become an advisor. You and I could just go out on the street and start recommending financial products to people. Now, SEBI has mandated that there is a mechanism by which you can register yourself as an investment advisor. So if you want to call yourself an investment advisor, if you have to use this term called investment advisor on your visiting card, for example, then essentially you have to go through SEBI in the entire process. SEBI is the certifying authority for it. They can grant certificate to both individuals and corporates, allowing them to become advisors. And they can then ask, and they usually ask for compliance documents from time to time, right? Compliance documents in terms of how does the process of advisory work? What is it to show that you advise? What is it to show that the advice is in the best interests of the client? So SEBI's idea is to actually look at the best interest of investors. They do a whole lot of other activities as well. So for example, they also run education and awareness campaigns that come up. They are also the regulator for the stock exchanges essentially. So in case companies are trading on the stock exchange, you will hear that SEBI will basically monitor if there is any unusual pattern of trading or if there is any kind of price manipulation that is happening on any of the stocks. SEBI is the watchdog as the market regulator, right? So this is in effect the market regulator in India. That's what SEBI is essentially, right? So that basically is broadly the role of SEBI. If anyone wants to become an advisor, they have to go through the Securities and Exchange Board of India, which is SEBI. Practically, it's difficult to implement a lot of these regulations because if in a small town in India someone is acting as an advisor, today it is difficult for SEBI to catch. But SEBI has mechanisms to catch all these people who might be mis-selling financial products or financial advice in India, and they are the regulator who is then going to put a penalty on any of these players, right? So that's SEBI. Similar to SEBI, in the context of insurance industry, there is this entity called IRDA, which is known as Insurance Regulatory and Development Authority. This controls all insurance companies in India. What are insurance companies? We will look at insurance in a bigger detail as we go along in terms of understanding what is the role of insurance in wealth management. But broadly, if you look at your vehicle insurance as an example, when you buy a car or a bike, you have to buy an insurance along with it. That's being sold by a company. That's to kind of protect the risk, right? So risk protection is what insurance basically covers you against. It gives you what insurance provides you. Risk is what it covers you against. IRDA is the certifying authority which conducts the certification program for insurance and general insurance, which is required for distributors. Remember distributors? Life insurance and general insurance are two kinds of insurance, and IRDA is the authority that will certify if someone wants to sell insurance products, then how do you go about essentially selling those? What is the regulation around that? They conduct the exam for this insurance regulatory. So if you want to sell insurance in India, if you want to become the agent of one of the insurance companies in India, you have to go through IRDA in terms of that process broadly, right? Then the next segment that comes is the stock exchanges. So what do stock exchanges do? They are essentially marketplaces where stocks trade. Mutual funds also trade there. They reflect the current value of the stock or commodity. They provide liquidity in the sense that you can easily exit from your holdings and buy the investment or sell the investment, right? So the idea of the stock exchange is to basically give you a platform to transact openly and quickly, right? So you can transact openly and quickly using the stock exchange. India has two stock exchanges, the bigger ones. One is called the BSE, which is the Bombay Stock Exchange, and then you have the NSE, which is the National Stock Exchange. NSE is the newer one, BSE is the older one, right? Both are essentially in Mumbai, but BSE was the older stock exchange, NSE is the new stock exchange that has come up. There are a couple of other exchanges as well, and there are regional exchanges. So you could have a Calcutta Stock Exchange and a Bangalore Stock Exchange and those kind of places as well. There are about 20 of those regional exchanges as well, but they're not very robust in terms of the larger companies are not listed on regional stock exchanges. Larger companies are essentially listed on the major stock exchanges, BSE and NSE, right? Then we have a couple of other entities called as the Depository and custodian. Let's understand depository first. So if you buy a share of Infosys, till about a couple of decades back, you would you would get a paper certificate around that share. Now there is a problem with the paper certificate because obviously paper certificates can get destroyed. There is a risk of theft, there is a risk of fraud, a lot of those things come in, right? So now what has happened is you get an electronic certificate. So how does it work? You basically, whenever you open a stock exchange account or you try and open a brokerage account to buy a stock, when you buy a stock, you also open what is called as a depository account with one of the depositories, right? What does the depository do? It allows the security to be held in dematerialized form. What do we mean by dematerialized? Electronic form. So if you buy a share of Infosys, it will show one Infosys in your depository account, in your what is called as demat account. Why is it called a demat account? Demat is a short form for dematerialized. So it will allow you to hold that stock in the demat account. And why is it useful? Because it's easy to trade because of this facility. Earlier, if you used to have a paper certificate, if I sell Infosys, I will have to courier that paper certificate to the other buyer who's going to be there. Now what happens is a direct transfer because it's an electronic facility. So it's just like your online or electronic banking, as your money is available in your bank accounts and you can transfer it from one bank account to another. Similarly, depositories have done that. Brokers and banks can offer depository services. Typically, all depositories are held by a couple of depository providers in India, but brokers and banks can offer those services. They can open this account for you, right? Idea of a depository is that at the back end, it is going to hold your shares or it is going to record the transactions that you have had. So it'll just tell you that you have 10 Infosys and 5 SBI and 10 ICICI Bank shares in your demat account, right? And when you sell, you can then buy and sell from those shares directly. Then we bring into the picture something called as a custodian. Now, what does a custodian do? It's typically a large financial institution like a bank. It holds securities and bank accounts on behalf of individual institutional investors, big investors, right? So when a mutual fund, for example, buys a lot of stocks or a big institutional investors buys a lot of stocks, they can't hold it in their account essentially. So what custodians do, because so the idea is, for example, what does a mutual fund do? And to understand this, we'll need to understand a little bit of a mutual fund. There are going to be a lot of investors who are going to give money to the mutual fund. The mutual fund goes and buys the stocks from the stock market by using this money. So the mutual fund buys stocks from the stock market, right? Where is this stock held now? They can't hold it in individual investor accounts. So they hold it with a custodian. Why a custodian? Because the custodian is responsible for these shares. The shares come here to the custodian. The custodian holds these shares and the custodian is responsible for the investor's investments, right? What happens if the mutual fund closes tomorrow? Who takes care of the investor? That's why the name custodian, because they take care of your investments. They keep the account of securities and money. They may also account for expenses and value of the portfolio for institutional investors. Typically, these are large banks because they are going to play the role of securing those securities, those stocks, right? When we mean securities, these are stocks or bonds or any of these instruments which are traded. So that's the role of a custodian primarily. Then we bring in the next entity, which is a broker or an advisor. A broker will basically, or an advisor will basically give you an advice and then put the buy sell transaction required for the clients. Several brokers and advisors provide research and recommendation and analysis about the securities on what stocks to buy, what funds to buy, what funds to sell, what stocks to sell to their advisors. So advisory, research, and transaction. These are the major roles that a broker or an advisor would basically play. right? So that's in a nutshell what a broker or an advisor does. Then we look at the product manufacturers. Remember, these are the asset management company or the insurance company. So effectively, you have an insurance company and an asset management company. Insurance companies provide you insurance, asset management companies give you the mutual funds, right? So they give you insurance. A lot of the entities, the bigger financial institutions, have both an AMC and an insurance, right? These are termed as product manufacturers. AMCs provide mutual funds, insurance companies provide various types of insurance products. Both asset managers and portfolio managers charge the investor a fee for the services. So every time there is an asset manager or an investor who's managing your money in a mutual fund or an insurance kind, in a fund that is run by an insurance company, there is going to be a fee charge. This is called as a management fee, right? Fund management charge or fund management fee is what is charged because they are managing your money and they're providing the services to kind of manage the funds, right? That's the role of AMC and insurance companies. Typically, they do the research around what stocks to be invested in the fund. So they will take money, they will invest the money on your behalf, essentially, right? So invest on behalf of investors, right? So they'll take the product and they'll offer the product and they'll invest on behalf of the investors. Then we have the role of NSE, specifically National Stock Exchange, one of the stock exchanges. NSE has an entity called the NISM, which is National Institute of Securities Markets, which provides a few courses which are important and mandatory if you want to sell mutual funds, for example, in India, right? So there is an NISM level 5A exam which is called the Mutual Fund Distributor Examination. If you want to sell mutual fund, that's mandatory for a distributor. If you want to become a distributor, you have to give this exam. If you join a firm where you are trying to sell mutual fund products, then mandatorily you have to give this exam. It's a small online exam, a couple of hours kind of an exam, not a very difficult one, but this is an exam that is mandatory that you have to give. Then they also conduct what is called as NISM level 10A and 10B. Now this 10A and 10B are mandatory exams mandated by the SEBI for calling yourself an investment advisor. So if you want to call yourself an investment advisor, in addition to the other application criteria that is there, you have to clear these two exams, NISM 10A and 10B. Level 1 and level 2 they are called, or level 10A and level 10B exams they're called, which again are online exams, and you're supposed to clear these two exams to be able to call yourself an investment advisor, right? That's the role of NISM or NSE in this overall segment, right? Now, let's also look very quickly at what is the regulation related to the advisory. Right? Now, there are some broad thumb rules that you have to look at. Any form of advice provided in relation to the investment, purchase, sale, or dealing in securities or investment products, the regulation will cover this, right? It also includes advice on a portfolio of securities or investment products or financial planning. So if you do any of these services, you are an investment advisor. Advice may be provided as a written advice or an oral recommendation or through any other mode such as email aimed to the benefit of the client. So if the client accesses emails, you advise through email. If the client wants a written advice, you send a written advice, etc. Advice that is widely available to the public through newspapers, internet, or magazines is not considered as investment advice under the regulation. So if someone has written a newspaper note saying that a certain stock is good, that's not considered as an investment advice. Everything else that you do here is considered as an investment advice, and if you're giving any of these services, you have to get registered as an investment advisor. That's the theoretical rule around what covers investment advisory, right? What are the roles and responsibilities or obligations and responsibilities of an advisor, right? So you have to disclose information that there is a conflict of interest, right? Which is how does the payment work in this? Typically, what SEBI has mandated now is that the advisory business has to be technically separated from what is called as the distribution business. So if you do both of these businesses, you have to separate the entities and keep an arm's length relationship between the advisory and the transaction segment. So this is the one which will execute the transaction. Even if the same firm offers both these services as a brokerage, the advisory division has to clear all the exams and everything, and that's separate from the distribution or transaction division, which basically executes the transaction. You can't advise if you are only a distributor, right? That's the idea. You have to you keep your client information confidential. You have to report to SEBI, and there's something called as know your client or know your customer compliance. That is an important part of the entire puzzle. If you want to invest in any mutual fund, you have to first be what is called as KYC compliant, know your client compliance. What is KYC? So we have picked up this excerpt from Reliance Mutual Fund's website. They allow you to do what is called as an eKYC. We will come to that separately. Know your customer is a customer identification process. The SEBI has laid down the guidelines for Prevention of Money Laundering Act, making it binding for financial institutions and financial intermediaries like mutual funds to acquaint themselves with their customers. You need to know whose money is being invested in financial markets, right? KYC process helps prevent money laundering. What is money laundering? Any suspicious transactions where you do not know what is the source of this money is what is money laundering, right? So how do we know if it is not money earned from smuggling? So essentially what it mandates is that KYC or know your customer rules ensure that there is an identification proof, right? And there is an address proof of the investor. So you could use something like your driving license or PAN card or the DL, right? Any of these documents or the passport can act as verifying documents about who the customer is, who the client is, right? Essentially, that's the idea. Anyone who's investing in the mutual fund markets needs to get the KYC done. It's a one-time process. So once you do the KYC, what does it do? On your PAN account, which is the permanent account number, which is given to every taxpayer in the country, right? Every taxpayer in the country has a PAN number. That's a unique number. This unique number is what will tell you whether you are KYC compliant or not. So when you put your PAN number into a mutual fund's website, you will know whether that particular PAN has already submitted the documents around KYC compliance, right? That's what a KYC means, and that's an important part of the entire regulation. That broadly covers who are the major regulators and major stakeholders for us. We can now move ahead in this particular curriculum about trying to find out what are the various asset classes in which investments can happen, and then what are the instruments like mutual funds, insurance, how do you calculate returns, what are the return mechanisms, how do you choose a fund versus another fund, and then taxation implications, finally closing it with the ethics in this particular industry and what can be done to kind of take care of those ethics, right? We end this particular session with a couple of questions. Explain about the various regulators in the securities and exchange and insurance market, and what do you mean by KYC or know your customer?